Hello everyone. Now let's finalize our discussion for the statement of cash flows in chapter 13. So the last part is to prepare the statement of cash flows, or in other words, to put it together. So in the next slide, we're going to see the statement of cash flow for Randall Incorporated, which is the company that we've been using as an example. And we can see that the three sections, and we can try to understand what happened with cash using the three different sections of the statement of cash flow. So again, one more time, I just want to remind you that we have to write the name of the company, the statement of cash flow, and then for the year ended December 31st, year 8, which is very similar to how we prepare the income statement or the title for the income statement. And then the top part, which is the cash flows from operating activities, that's prepared using the indirect method. And you can tell because we're starting with net income. And then we have the adjustments. And you can see here the depreciation, the gain from the sale of land was subtracted, and all the changes in current operating assets and liabilities. And that gave us the net cash flow from operating activities, which is $100,500. Then we have a section for the cash flow from investing activities. And we have cash received from sale of land, and that's a positive number. And then cash paid for purchase of land, which is a minus or a negative number. And then cash paid for purchase of building, and also it's a negative number. We add them, and we can see here it's a net cash outflow, or in other words, cash flow used for investing activities. And then we have cash flow from financing activities, and we have here amount of cash received from the issuance or the sale of common stock, $48,000. And we also have cash paid to retire bonds and cash paid for dividends. And these are negative values. We add them together and we still have a negative value. So the net cash flow used for financing activities is the $26,000. So you can see that we have positive value for operating activities and a slightly negative value for investing activities. And then for financing activities, we have the negative $26,000. Yet the total net cash flow is increasing because if we add these three values, it's $71,500, which is, I think it's a positive thing. The beginning balance for cash was 26. We add to it the amount of change, which is the increase in cash. So we get the cash balance at year end to be 97,500. So that's a typical statement of cash flows. Again, one more time, we have the operating activity, we have the investing activity, financing activity. We combine them all together. We add it to the beginning balance to get the ending balance. And that's how we can understand the statement of cash flows. Now let's do some analysis for decision making. And one of the ratios related to the statement of cash flow is something called ratio of free cash flow to sales. So what is the free cash flow? The free cash flow measures the operating cash flow available to a company after it purchases the property, plant, and equipment necessary to maintain its current operations. So since the investment in property, plant, and equipment necessary to maintain current operations cannot often be determined from financial statement, analysts estimate this amount using the cash used to purchase property, plant, and equipment as shown in the statement of cash flows. So the free cash flow, how can we compute it? Again, we get the net cash flow from the operating activity section, only the top part. Then we see the cash used to purchase property, plant, and equipment. We're going to subtract that to get the amount of the free cash flow. So this is a very unique kind of measure, but it's going to be used in order to calculate the next ratio, which is the ratio of free cash flow to sales. So the free cash flow can be expressed as a percentage of sales in order to provide a measure that can be compared over time or to other companies. And simply we get the free cash flow that we just calculated in the previous slide. We divide it by sales. And if we have a positive free cash flow, this is considered to be favorable. A company that has a free cash flow is able to fund growth and acquisitions, retire debt, purchase treasury stock, and they can also pay dividends. A company with no free cash flow may have limited financial flexibility, potentially leading to liquidity problems. So here we have an example for the National Beverage Corporation, and this is coming from their annual report for the most recent 3 years. And you can see that free cash flow increased in year 2, but returned to year 1 level in year 3. And see here the 10%, 12.1, 12.6, and 10%. But this is the amount of the free cash flow divided by the sales. So you can see it was 100, went up to 122, then went down to 101. So, but the percentage went down slightly in year 3 because sales was increasing, yet the free cash flow went down a little bit. So I hope this was helpful to understand and learn about the statement of cash flows. We've seen all the details. Let me know if you have any questions, and I wish you all the best.